Well, good morning. Yendra Rana here. So, taking up the topic today, the profitability of the general insurers of India. Profitability of the general insurers of India. See, every business works with the intent of making a profit. The success of every business depends on its ability to constantly earn profits. Profit in business usage is the excess of total revenue over total cost during a certain period of time. The profit is equal to a company's revenue minus expenses. For insurance companies, annually profit margin represents yearly profitability averages. Those margins measure how well a particular business company does over a period of time. So from the perspective of insurance companies, or from the perspective of insurance companies, profit margins are an important part of tracking the internal performance of the company. Let's understand a little about the ways of insurance companies to calculate the profit. So to calculate the profitability of a general insurer, the most common method is to use the combined ratio, which measures the total claims paid out and operating expenses relative to the premiums collected, essentially showing whether the company is making a profit on its underwriting activities. A combined ratio below 100 indicates profitability, while a ratio above 100 indicates a loss. So while calculating the combined ratio, the formula is combined ratio is equal to incurred losses plus incurred expenses upon earned premiums. So key components of combined ratio is loss ratio. And loss ratio represents the proportion of claims paid out compared to earned premiums. And the calculation is loss ratio is equal to incurred loss upon earned premiums. Second one is expense ratio. This expense ratio represents the proportion of operating expenses compared to earned premiums. And the calculation of expense ratio is equal to incurred expenses upon earned premiums. Expense ratio is equal to incurred expenses upon earned premiums. So combined ratio below 100 indicates the insurer is making a profit on its underwriting operations. And combined ratio above 100 indicates the insurer is experiencing an underwriting loss. So the important considerations in this entire process are investment income. While the combined ratio focuses on the underwriting aspects, a profitable insurer may also generate significant income from investments on its premium reserves. Then the reinsurance. Insurers often use reinsurance to transfer a portion of their risk to other companies, which can affect the combined ratio. And then there is a product mix. Means different insurance products can have varying profit margins, so analyzing profitability at a product level can be valuable. So normally following methods are used by insurance companies to calculate profits. Profit in the most basic sense is the company's revenue cost. So therefore, basic formula to calculate profit for the insurance companies is profit is equal to premiums plus return on premiums minus claims minus expenses. I repeat, profit is equal to premiums plus return on premiums minus claims minus expenses. So even if the payout for claim is 100% of the premiums collected, which is never the case, the insurance company can still earn profit by investing the premiums. This becomes clearer by the following example. Suppose there are 500 customers who pay an average premium of $2,000 annually. So the insurer invests the money in stocks or bonds and gets a 16% return after investment cost. So the total premium is equal to $1 million. Claims is equal to $1 million, means 100% of premiums, and expenses is equal to $100,000, 10% of the premium. Now the underwriting profit, premiums minus claims minus expenses, is equal to $100,000. So investment profit is equal to $160,000, that is 16% of the premiums. And total profit $60,000, or 6% of the premiums. That means profit margins are perhaps the most widely and simply used financial ratios to calculate the profit of a company. The profit margins of a company are measured at 3 levels. The most basic is gross profit and the most comprehensive is net profit. So between these two, operating profit lies. All three have respective profit margins which are calculated by dividing the profit figures by revenue and multiplying by 100. So analyzed profit margins for an insurance company can change from year to year based on the number of claims it receives, policy price changes and changes in the cost of the services. Now takes a closer view of these profit margins one by one. Say gross profit margin. The gross profit margin is a ratio. Gross profit margin is a ratio that shows the performance of a company's sales and production. This ratio is made by accounting for the cost of goods sold, minus which include all costs generated to produce or provide any product or service, and the total revenue. So the gross profit margin is usually expressed as a percentage of sales and is called the gross margin ratio. If a company's business has a gross profit margin of 24%, it means that 24% of the company's total revenue became profit. So a higher gross profit margin indicates a higher work efficiency of a company. The gross profit margin is calculated by deducting the cost of goods sold from total revenue and dividing the number by total revenue. So the formula for calculating the gross profit margin ratio is gross margin ratio is equal to total revenue minus cost of goods sold upon total revenue. The formula for calculating the gross profit margin ratio is gross margin ratio is equal to total revenue minus cost of goods sold upon total revenue. Then the second one is operating profit margin. So the operating profit margin indicates how much profit a company makes after paying the variable cost of production, such as payments, wages, or claim, etc. So it is also expressed as a percentage of sales and then determines the efficiency of a company by comparing the cost and expenses associated with business operations. The operating profit margin is a performance ratio that is used to determine the profit percentage of the company produced from its operations before subtracting taxes and interest charges. So this margin is also known as EBIT. EBIT means earnings before interest and tax margin. So the operating profit margin ratio is calculated by dividing the operating profit by total revenue and expressing it as a percentage. The formula for this margin ratio is operating profit margin is equal to operating profit upon gross revenue. This operating profit is worked out as operating profit is equal to sales minus operating expenses minus cost of goods sold. So I repeat the formula. The formula for this margin ratio is operating profit margin is equal to operating profit upon gross revenue. And the third is net profit margin. So the net profit margin, also known as a net profit margin ratio, is a financial ratio used to calculate the degree of profit of the company produced from its total revenue. So it measures the amount of net profit that a company obtains per dollar or per rupee of revenue gained. So the net profit margin is equal to net profit divided by total revenue. It is expressed as a percentage. The difference between the operating profit and the net profit is that the former is based solely on the operating expenses by excluding the cost of interest payments and taxes. So the formula for net profit margin is net profit margin is equal to net profit upon total revenue. Now here net profit means net profit is equal to sales minus cost of goods sold minus operating expenses minus taxes. Net profit means sales minus cost of goods sold minus operating expenses and minus taxes. So the formula for net profit margin is the net profit margin is equal to net profit minus total revenue. Now, insurance companies calculate their profit and loss accounts by considering various factors specific to the insurance industry. These factors include the collection of premiums, payment of claims, expenses related to individual policies, investment returns, and non-specific expenditures. So the technical profit of an insurer on an individual policy is determined by the excess of premium collected over claims amount paid and policy specific expenses. Additionally, the contribution from investment returns on each cash flow generated by the policy and non-policy specific items such as profit commissions are taken into account. So the calculation of profit and loss accounts requires the completion of the exposure period of risk and the settlement of all claims. Actual accounting methodology is used which involves estimating future state of nature and factoring these estimates into complex discounted flow calculations. So when the loss ratio is to be worked out, it is important that a loss ratio is a fundamental financial metric used in the insurance industry to measure the profitability of an insurance company. It is calculated as the ratio of incurred losses, that is including claims paid, loss reserves and loss adjustment expenses, to the earned premiums over a specific period. So the loss ratio serves as an indicator of how effectively an insurance company is managing its risk exposure, underwriting policies, and pricing its products. So a lower loss ratio typically indicates better profitability, as it means the company is paying out less in claims related to the premiums collected, while a higher ratio suggests the company may be paying out more in claims and experiencing financial difficulties. So the ideal loss ratio varies depending on the types of insurance and the specific company's business model, but it generally falls within the range of 40% to 60%. So a loss ratio below this range could signify that the insurer is underwriting too conservatively, potentially missing out on business opportunities or charging too high premiums, which may lead to customer dissatisfaction and loss of market share. So conversely, a loss ratio above the ideal range may indicate inadequate underwriting, pricing or risk management practices, resulting in a higher frequency or severity of claims. In such cases, the insurance company may need to re-evaluate its strategies to maintain financial stability and ensure long-term sustainability. The importance of the loss ratio in the insurance industry cannot be overstated, as it serves as a critical benchmark for evaluating an insurer's financial health, underwriting practices, and overall business performance. So by monitoring loss ratio, insurance companies can identify trends, uncover potential issues in their risk management processes, and make informed decisions to optimize pricing and underwriting strategies. Furthermore, regulators, investors, and rating agencies often use the loss ratio to assess the stability and profitability of the insurance companies, making it a key performance indicator that can impact a company's reputation, market position, and access to capital. So overall, maintaining an appropriate loss ratio is vital for insurance company to ensure sustainable growth, operational efficiency, and long-term success in a competitive market. Thank you very much.